The start of any alt-season narrative is the emotion it generates, excitement, urgency, and the vivid promise of outsized returns. That feeling is useful only if it is recognized as a market signal rather than a decision maker. Understanding the nature of the hype that accompanies alt-season is the first step toward treating it as an opportunity instead of a trap. Hype compresses attention and capital into a small set of assets, and while it amplifies upside potential, it simultaneously shortens the window for rational decision-making. When you accept that hype will arrive and that its primary effect is to accelerate both buyers' enthusiasm and price movement, you can plan around it instead of being carried away by it. The trap manifests when excitement overrides process. Emotional reactions, fear of missing out, envy of others' gains, or the urge to double down after a rapid rise lead to decisions made without a framework for entry, profit-taking, and exit. A professional approach reframes these impulses as inputs to a disciplined system. Instead of letting emotion dictate timing, you define the conditions under which you will act. That means translating excitement into measurable signals you trust and routing impulses through protective rules that prioritize capital preservation and clear objectives. Treating hype as a variable to manage rather than a force to follow converts a chaotic moment into a structured trading environment. Risk management and preparation become the core of any successful alt-season strategy. Before participating, a professional investor clarifies how much capital is allocated to speculative alt positions relative to core holdings and sets explicit rules for protecting gains. This mindset reduces the chance of being the last buyer at peak euphoria, and it prevents panic-driven behavior when the market corrects. Importantly, the emphasis is not on avoiding volatility altogether. Volatility is the mechanism that produces opportunities, but on ensuring that volatility cannot produce irreversible damage to your financial position. When protection is embedded into your approach, you can pursue upside without gambling away your foundation. Finally, the introductory discipline is cognitive. Remain curious but skeptical. Curiosity allows you to scan for high-probability setups that appear during alt-season, while skepticism keeps you from conflating noise with signal. Developing this balanced outlook is a habit that underpins every tactical choice you make during a bull run. It ensures that when alt-season arrives, you do not simply react to the loudest narratives, but instead respond according to a repeatable plan that privileges measured gains and controlled exposure. This psychological grounding is what separates memorable, sustainable gains from short-lived windfalls that leave you exposed when the market shifts. Before you can make real gains in alt-season or navigate a bull run like a pro, you must first understand the forces that shape these explosive market moments. The crypto market doesn't move randomly. It follows cycles, driven by psychology, dominance shifts, and liquidity flow. So before chasing the next big pump, let's start at the foundation. In this first chapter, we'll uncover what alt-season truly is, what sparks it into motion, and how investor psychology fuels both opportunity and risk during a bull run. Alt-season represents a distinct phase within the broader crypto market cycle, where altcoins, any cryptocurrencies other than Bitcoin, begin to outperform Bitcoin in terms of percentage growth and market momentum. It is a shift in capital concentration, where investors rotate profits accumulated from Bitcoin's previous uptrend into smaller cap assets that have higher volatility and, potentially, greater short-term upside. This period is marked by a surge in speculative energy, as traders seek exponential gains in emerging tokens once Bitcoin's movement appears to stabilize or slow down. The trigger for Altseason usually begins with a decline in Bitcoin dominance, which measures Bitcoin's share of the total cryptocurrency market capitalization. When Bitcoin dominance starts to fall, it signals that money is flowing into other assets, indicating broader risk appetite among investors. This shift doesn't happen in isolation. It's often supported by growing optimism across the entire market. As confidence expands, capital begins to chase opportunities beyond Bitcoin, searching for projects that could deliver larger multipliers within a shorter period. This flow of liquidity intensifies as more participants join, creating a feedback loop that propels altcoins to new highs. However, Altseason is not just about numbers or price movement. It's about understanding the rhythm of the market's internal behavior. It reflects the psychological evolution of investors from caution to ambition, a point where belief in market growth becomes widespread and risk-taking feels justified. Recognizing when Altseason is beginning allows a disciplined investor to position strategically, while understanding when it is overheating helps in protecting profits before the inevitable correction. The real skill lies not in identifying that Altseason exists, but in interpreting what its momentum means in relation to the broader market structure and timing your actions accordingly. Understanding the bullrun psychology. A bullrun is more than a phase of rising prices. It is a psychological ecosystem that evolves in predictable emotional waves. It often begins with quiet optimism as early signs of recovery appear, followed by confidence as prices continue to climb. Gradually, this optimism transforms into euphoria when profits become extraordinary and the narrative of endless growth takes hold. At this peak, emotional reasoning often replaces rational judgment, and greed drives decisions more powerfully than analysis. When the cycle matures and prices begin to stall or reverse, that same emotion turns into anxiety, then panic, as participants rush to secure profits or limit losses. Understanding this emotional pattern is essential because markets are fundamentally driven by collective psychology, not logic. The shift from optimism to greed and eventually to fear defines where most participants make their worst decisions, buying near the top and selling near the bottom. Recognizing that these emotions are cyclical allows you to detach from them and interpret them as signals instead of instructions. A professional investor doesn't attempt to eliminate emotion, but rather build systems that account for it, using predefined rules for entry, exit, and capital protection to neutralize its influence. During a bull run, the greatest danger lies in becoming what is often called exit liquidity, the late entrant who buys into euphoria when experienced investors are already taking profits. Avoiding this outcome requires awareness of how crowd psychology shapes behavior. Step 1 is to identify the emotional temperature of the market through sentiment analysis and media tone. Step 2 is to measure your own reactions against that atmosphere, noting when excitement feels stronger than logic. Step 3 is to respond with discipline, not emotion, aligning actions with data and trend confirmation instead of hype. Mastering this psychological dimension is what allows a trader to navigate a bull run like a professional, staying grounded, deliberate, and one step ahead of the crowd. As we've seen, Altseason is more than just a time of explosive growth. It's a psychological battlefield where excitement turns to euphoria and emotion often clouds logic. But while most investors ride the emotional waves, the professionals prepare quietly behind the scenes. In the next chapter, we'll uncover how smart money moves, how seasoned investors plan, position, and profit before the hype even begins. The smart money strategy is centered on foresight, preparation, and calculated execution, the very principles that separate seasoned investors from emotional participants. In every market cycle, the most successful investors act before the majority recognizes opportunity, positioning themselves quietly during phases of accumulation when prices are relatively stable and public attention is low. This is not luck or coincidence. It is the result of deliberate observation, research, and timing. Smart money understands that market sentiment follows predictable waves, and they aim to be early during quiet periods, then gradually reduce exposure as hype builds and volatility intensifies. The essence of this strategy lies in recognizing that profit is not made by following the crowd, but by anticipating its behavior. Step 1 is identifying early signals, such as rising trading volume, improving project fundamentals, and strengthening sentiment that suggest a potential uptrend before mainstream attention arrives. Step 2 is entering positions incrementally, focusing on high-quality projects with strong liquidity and sustainable growth potential. Step 3 is exercising restraint during the euphoria phase, when emotional traders chase rapidly inflating prices. Smart investors understand that by the time hype dominates, the risk-to-reward ratio has already shifted unfavorably. Equally important to entry is knowing how and when to exit. Professional investors apply structured profit-taking mechanisms that allow them to secure gains systematically while leaving room for further upside. This can include setting target levels where portions of profits are rotated back into safer assets such as Bitcoin or stablecoins. Such rotation serves two purposes: preserving earned capital and maintaining flexibility to re-enter the market when the next correction or accumulation phase begins. By gradually moving profits into lower-risk positions, smart money protects against the inevitable downturn that follows excessive speculation. This approach is not driven by emotion, but by discipline. While the crowd becomes intoxicated by rising prices, smart money quietly exits, converting volatility into stability. When the bubble bursts, as it inevitably does, they are positioned with liquidity, ready to buy back quality assets at discounted levels. The smart money strategy is therefore not merely a technique, but a mindset of foresight, patience, and self-control. It's the art of moving strategically while others move emotionally, ensuring that every decision contributes to sustainable growth rather than short-lived excitement. Now that we understand how experienced investors strategize their entries and exits, it's time to learn how they recognize when the next big wave is coming. Smart money doesn't chase trends. It identifies signals long before the crowd notices. In this next chapter, we'll break down the key indicators that reveal when alt-season is approaching, helping you position yourself early, not emotionally. Recognizing the early signs of alt-season is a skill that allows investors to position themselves strategically before explosive market movements occur. Alt-season doesn't happen randomly. It follows identifiable patterns rooted in market structure, capital flow, and investor psychology. The first major signal to monitor is the decline in Bitcoin dominance. Bitcoin dominance measures the percentage of the total cryptocurrency market capitalization that Bitcoin holds. When this number begins to drop, it typically indicates that investors are moving profits from Bitcoin into alternative coins, altcoins, in search of higher returns. A steady or sharp decline in dominance suggests that liquidity is rotating, marking the early stage of an altcoin-driven rally. The second key indicator is a sharp increase in mid-cap altcoin volumes. Mid-cap altcoins, those with moderate market capitalization but strong fundamentals, often act as the bridge between Bitcoin and smaller speculative assets. When trading volumes in this category begin to surge, it signals that market participants are becoming more confident in taking on additional risk. Increased volume reflects growing attention, speculation, and active participation, all of which are crucial precursors to a broader altcoin rally. Step 1 is to observe consistent volume growth across multiple altcoins, rather than isolated spikes. Step 2 is to confirm that these moves are supported by genuine market momentum, not artificial hype or short-term manipulation. Another important factor is retail attention returning to social media and search trends. Platforms like X, formerly Twitter, Reddit, and YouTube often provide subtle yet powerful clues about rising market enthusiasm. When discussions about altcoins begin to dominate online spaces, when hashtags related to specific coins trend, and when new investors start asking repetitive entry-level questions, it often reflects a transition into the speculative phase of the market cycle. This social momentum amplifies price movements as retail investors rush to participate, pushing altcoins to new highs. In essence, recognizing Altseason is about observing the flow of money, behavior, and sentiment. Bitcoin's dominance decline shows where capital is moving. Rising altcoin volume shows how it's being deployed, and retail chatter shows who is entering the market. When all three indicators align, it's a strong signal that Altseason is either beginning or gaining momentum. Smart investors use this knowledge not to chase the trend, but to time their entries carefully, manage exposure, and prepare exit strategies before euphoria turns into exhaustion. Recognizing Altseason signals gives you an advantage, but awareness alone isn't enough. Even the most promising setup can turn into a trap if discipline fades. Next, we'll dive into the most common mistakes investors make during Altseason, and more importantly, how to avoid them before they erase your gains. During Altseason, emotions often run high, and even experienced investors can fall into traps that erase weeks or months of gains within days. One of the most common mistakes is buying at the top after massive green candles. This usually happens when investors allow fear of missing out, FOMO, to override logic. When prices surge dramatically, many assume the momentum will continue indefinitely. However, large green candles often signal exhaustion, the final phase of a bullish move where smart money is quietly exiting while retail investors rush in. Step 1 is to recognize that rapid parabolic gains are unsustainable. Step 2 is to avoid entering after extreme price spikes and instead wait for healthy retracements that confirm stability before considering entry. Another frequent pitfall is over-leveraging trades or chasing meme coins. Leverage amplifies both gains and losses, and in a volatile market like crypto, it often leads to liquidation when sudden price swings occur. Many traders use borrowed funds to maximize returns, but without proper risk management, this approach can wipe out portfolios in seconds. Similarly, meme coins, tokens with no real utility or fundamentals, tend to surge rapidly during hype phases and crash just as fast. Chasing them for quick profits can lead to devastating losses once liquidity dries up. Step 1 is to use leverage cautiously, if at all. Step 2 is to focus on projects with credible value rather than speculative hype. Step 3 is to prioritize preservation of capital over short-term thrill. A third major trap is ignoring exit plans or profit targets. Many investors enter trades with enthusiasm but fail to define when to sell. Without a clear plan, emotions take control. Greed during gains and fear during corrections. The absence of structured exit points often results in holding through reversals, turning profitable positions into losses. To avoid this, create predefined profit targets and stick to them. Step 1 is to decide what percentage of profit justifies partial or full exits. Step 2 is to execute those exits consistently, even if it feels premature. Discipline always outweighs emotion. Lastly, a subtle yet costly mistake is not converting to stablecoins in time. As the market overheats, preserving gains becomes crucial. Stablecoins allow investors to lock in profits without leaving the crypto ecosystem, offering a safe harbor during corrections. Failing to move profits into stable assets when the market begins to show signs of exhaustion often leads to watching those profits evaporate as prices correct sharply. Step 1 is to monitor sentiment and volume shifts that signal weakening momentum. Step 2 is to convert gradually rather than all at once, reducing exposure while maintaining flexibility. In summary, these traps, buying tops, over-leveraging, chasing hype, neglecting exits, and delaying conversions, stem from the same root cause: emotional decision-making. Altseason rewards discipline, not excitement. The investors who make and keep profits are those who remain calm amid volatility, plan every move with precision, and treat every rally as an opportunity to secure gains rather than gamble for more. Avoiding traps is only the first step. True mastery comes from learning how to protect and grow what you've earned. In the next chapter, we'll explore how professionals lock in profits, manage risk, and compound gains even when markets turn volatile. Because in crypto, keeping your profit is just as important as making it. Securing and compounding gains during alt-season is the defining difference between investors who walk away profitable and those who lose everything in the market's inevitable correction. The first and most essential principle is taking profits regularly. In a rapidly moving market, prices can change dramatically within hours, and unrealized gains can vanish just as quickly. Many traders fall into the trap of waiting for the next leg up, only to see their portfolios crash when momentum fades. Step 1 is to establish profit checkpoints, predetermined price levels where you will take partial profits. Step 2 is to automate these actions when possible, reducing emotional interference. Regularly taking profits doesn't mean you lose potential upside. It means you lock in certainty amid volatility. Another key to protecting your gains is using risk management tools effectively, such as stop-loss orders, portfolio tracking systems, and clearly defined exit zones. Stop-loss orders help you limit downside risk by automatically selling assets once they drop to a set threshold. This ensures that emotions don't delay your decisions in moments of panic. Portfolio tracking tools, on the other hand, provide a clear overview of your asset performance, allocation balance, and exposure to volatile sectors. They keep you aware of when your portfolio becomes overly concentrated in high-risk assets. Defining exit zones, specific price regions where you will begin taking profits or reducing exposure, is equally important. Step 1 is to identify your entry point and set realistic targets based on technical and market conditions. Step 2 is to consistently update your stop-loss levels as prices move in your favor, securing profit while maintaining room for growth. Finally, the path to compounding your gains lies in diversifying your profits into stronger, long-term assets like Bitcoin, Ethereum, or other fundamentally sound projects. These assets tend to retain value better during market downturns and serve as anchors of stability in a volatile ecosystem. Instead of keeping all your gains in speculative altcoins, gradually rotate a portion of them into these higher confidence assets or even into stablecoins for safety. Step 1 is to allocate a percentage of every profitable trade into more established coins. Step 2 is to hold these assets in secure wallets with a long-term vision. Step 3 is to reinvest strategically when new opportunities arise in future cycles. The essence of compounding in crypto is not about chasing constant high returns. It's about protecting what you earn and letting your portfolio grow through disciplined reinvestment. True mastery during alt season comes from knowing when to take money off the table, how to protect your capital, and where to reposition it for sustainable growth. The investors who thrive across multiple cycles are those who don't just make gains, they secure, protect, and multiply them with patience and precision. You've now learned how to take profits wisely and manage your portfolio with discipline. But to truly sustain success, you must think beyond the next trade. In our final chapter, we'll uncover the mindset and research habits that separate short-term speculators from long-term investors, those who don't just survive bull runs, but thrive through every cycle. In every alt season, the divide between short-term traders and long-term investors becomes crystal clear. Short-term traders often chase quick profits, jumping rapidly between trending coins in search of fast flips. Their decisions are driven by daily market movements, social media hype, and emotional impulses. This mindset, while thrilling, exposes investors to immense risk, especially when the market turns abruptly. On the other hand, disciplined long-term investors focus on building sustainable positions based on research, conviction, and strategic patience. They understand that true wealth in crypto comes not from chasing every green candle, but from identifying strong projects early, holding through cycles, and compounding growth over time. Step 1 is to adopt patience as a strategy, not just a virtue. Step 2 is to prioritize learning over reacting. Over multiple cycles, it's often the calm, research-driven investors who outperform those driven by short-term excitement. However, developing a long-term mindset is only possible when it's grounded in proper research, DYOR, or do your own research. In a market filled with hype, misinformation, and exaggerated promises, DYOR is your defense against emotional and costly mistakes. Many investors fall into traps because they rely on influencers or viral trends rather than personal due diligence. DYOR means taking full responsibility for every move you make. It's about understanding what you're investing in and why. Before buying any token, step 1 is to examine the fundamentals, review the project's white paper, understand its mission, and assess whether it solves a real problem in the blockchain ecosystem. Step 2 is to evaluate the team's credibility, ensuring they have transparent identities, relevant experience, and a proven track record in technology or finance. A strong team usually reflects long-term potential, while anonymity or vague backgrounds can signal risk. Step 3 is to analyze tokenomics, including supply structure, utility, distribution, and mechanisms that maintain value. Poorly designed tokenomics often lead to inflation or manipulation. Finally, step 4 is to assess community engagement and adoption. Genuine projects foster organic, informed communities, while hype-driven ones rely on short-term marketing buzz. When you combine a long-term mindset with the discipline of thorough research, you create a powerful foundation for sustainable investing. You stop reacting to noise and start acting with purpose. Patience, supported by knowledge, helps you hold through volatility with confidence. Every decision becomes intentional, not emotional. This approach shields you from being trapped during market peaks and empowers you to recognize genuine opportunities long before the crowd notices them. In the end, long-term success in crypto is not about timing the market. It's about understanding it, trusting your research, and letting time and discipline work in your favor. Altseason represents one of the most exciting and potentially profitable phases of the crypto market, but it's essential to remember that it's an opportunity, not a guarantee. Many investors are drawn in by the explosive growth of altcoins, believing every surge will continue indefinitely. However, true success in a bull run comes not from following the crowd, but from understanding the rhythm of the market. Altseason rewards those who prepare ahead, who study market cycles, manage their risks, and make data-driven decisions rather than emotional ones. The difference between those who walk away with real gains and those who get trapped in the hype often lies in one thing: discipline. To navigate a bull run like a pro, timing, strategy, and emotional control must work together. Timing ensures you position yourself early, before the crowd notices. Strategy gives you a framework to take profits, rebalance, and secure gains without losing focus. Emotional control keeps you grounded when prices surge or crash, allowing logic to guide your actions instead of greed or fear. Each bull run brings waves of euphoria and panic, but the professionals, those who survive and thrive, stay calm, patient, and calculated. They know that every market cycle, no matter how dramatic, eventually resets. What matters is not how fast you gain, but how much you preserve and grow over time. At Crypto Education Zone, CEZ, the goal is to equip you with the mindset and tools to think like a professional investor. The message is simple, yet powerful. Don't just chase trends, master them. The crypto market will always reward those who combine knowledge with patience, emotion with logic, and ambition with caution. As you move forward into future cycles, remember that mastery doesn't come from luck. It comes from preparation, discipline, and continuous learning.